The Federal Reserve, here's what they watch. They watch inflation, they watch the jobs numbers, they see how the economy is going, and they set rates over through there. So that's what the stock market and the bond market tries to do. They try to take this data and say, okay, based on this data, what's the most logical outcome of all these things? Well, we have one tool to figure out what the Federal Reserve is going to do. Let's get over to that. And that's called the FedWatch Tool. And it's right through here. The CME group, that's the Chicago Mercantile Exchange, they put together this tool and they come out and they say, okay, here's the most likely outcome of what the Federal Reserve is going to do at the next meeting. Well, the next meeting is in 36 days. And if you go down through here, it's the probability is 82% that they're not going to do anything. So this is what the markets are looking at. But they're saying there's not going to be any cuts at the next meeting. There's not going to be any cuts at the following meeting after that. And then it's a whole new cast of characters at the Fed. And then we're going to have one or two maybe other members of the Fed. You know how they're going to vote. They're going to say, okay, let's cut. Well, maybe not necessarily. And even if they do, does that mean mortgage rates are going to come down? Do you realize we had like 3 Septembers in a row, not this past one, but 3 Septembers in a row where the Federal Reserve came out and cut rates. And within, I think it was about a week, rates went up 1 full percent. It was different times, but that is the reality of things, especially when it comes to these things over here. So next time I say it, get a little excited because if you're a homeowner, you're a home buyer, you're a realtor, you're a loan officer, maybe now you understand a little bit more about these things.